Hello, everybody, and welcome to my lecture series on bad debt. This is part 2. And in the last video, we learned about what bad debt was, and we learned about the allowance method and why it is the preferred method, but we didn't actually talk about how we do the accounting under the allowance method. So in this video, part 2, we're going to learn the actual journal entries required to establish the allowance, to write off bad debt, and then to adjust the allowance, as we're going to have to do every single accounting period. In part 3, I'm going to talk about how we actually come up with the estimate for the allowance, because that's what the allowance is. It's an estimate of your bad debt. So in this video, we're not going to talk about how we come up with that estimate, but that will be in part 3. So as we mentioned in the last video, what the allowance method says is that every company must estimate bad debt and record bad debt expense every accounting period, even if you don't want to give up yet. Okay, so because we know that different companies are going to have different thresholds for when they're ready to give up, and that causes inconsistent and unreliable financial information. So in order to make it reliable and make it consistent and comparable between different companies, regardless of each company's different policy, we have to have the allowance method. And again, that goal is so that we have reliable, comparable financial information for investors and creditors. So how do we make this happen? Well, as I mentioned in the previous video, the allowance method says that we're going to record expense every period, whether we give up or not. And so this causes us then to have a balance sheet that matches the conservatism principle, where we're showing less optimistic estimate of what we're going to collect. And it also causes our income statement to follow the matching principle, because we're matching the expense of bad debt with the related revenues that we took that risk on in the first place, right? We took the risk of a credit sale in order to make that sale, to make that revenue, and that risk happened at the time that we made that sale. So we want to match the risk with the related revenue. So the first thing we need to do under the allowance method is to establish the allowance. And that is the first entry that we're going to learn at this time. So here's our example. It says, during 2013, Jennison Inc. had $100,000 of credit sales. During the year, Jennison Inc. collected $75,000 of those credit sales. Of the remaining balance, Jennison Inc. estimates $2,500 may not be collectible. Okay, so as you can see here, there's our sales of $100,000. It's on the debit side of accounts receivable. And that's just all throughout 2013. And then all throughout 2013, we collected $75,000 of that, and that's on the credit side, which reduces our accounts receivable. And that leaves us now with a balance of $25,000. And the problem is saying, of that balance of $25,000, we estimate that $2,500 may not be collectible. Again, I'm not going to talk in this video about how we came up with that estimate. I'm going to talk about that in the next video. But for now, I just want you to understand the mechanics, the journal entry. Okay? So, again, the allowance method says every company must estimate bad debt and record the expense every accounting period, even if you don't want to give up, right? We're not ready to give up yet. So we just got out our crystal ball and we came up with, we think $2,500 of that is uncollectible. So as we mentioned, every company must record bad debt expense. So we know that part of our entry to establish the allowance is going to involve bad debt expense. And that bad debt expense is going to be based on our estimate of $2,500. And this is similar to the direct write-off method that we learned in the last video, that we're going to record the bad debt expense at this time. However, this is not at the time of a write-off. This is just, if you'll notice here, at the end of the year, right? I don't have to write it off in order to record bad debt expense. I just have to make an estimate, and that estimate, again, is going to happen at the end of every accounting period. So at the end of this accounting period, I estimate $2,500 is uncollectible, not write off, not give up. I just estimate $2,500 is uncollectible. So I'm going to record the bad debt expense at that time, at the time I make that estimate. But what should the other side of the entry be? Because we're not ready to write it off yet, right? If we were going to write it off, we would take it out of accounts receivable, but we're not ready for that yet. So what do we do instead? Well, instead, we use a new account called Allowance for Doubtful Accounts, which I shortcut to AFDA. Okay? And what AFDA is, or the Allowance for Doubtful Accounts, is it's a contra asset used to show an estimate of accounts receivable that may not be collectible. Okay. So I'll show you what that looks like. Okay. So our entry then will be the debit to the bad debt expense, $2,500, and our credit will be to allowance for doubtful accounts of $2,500. Okay. In other words, we're crediting this estimate. And what that looks like overall for the financial statements is this. We have our asset, which is accounts receivable, and our contra asset, allowance for doubtful accounts. And to refresh your memory, contra asset, that word contra means against, so it's going against the accounts receivable. So in other words, rather than crediting accounts receivable to say we give up on this accounts receivable, we're not ready to give up yet, instead we put it here as an estimate. And this estimate goes against our asset, right? We're saying we don't think we're actually going to collect $25,000. We think $2,500 we won't collect. We're not ready to write it off and take it out of the asset, so we're just going to put it here in the estimate, which is going to go against that asset. Okay, so what happens on our 2013 balance sheet is that we net the asset with the contra asset. So the line item you see on the balance sheet will say accounts receivable net. Okay, it will literally say that on the face of the balance sheet. And for a lot of you guys, if you look at your financial statements for your team projects, you'll see it says accounts receivable net. And that's what they're referring to, is it's net of this estimate of uncollectible accounts. So we've netted the two, taken the debits from this side, offset them with the credits from the contra account, and therefore our balance sheet now is showing an asset of $22,500. Okay? And this allows our balance sheet to follow the conservatism principle. We're showing the least optimistic estimate of what we're going to get. Because this is overly optimistic. We'd love to receive all of it, but that's overly optimistic. This is a more conservative estimate, less optimistic, more realistic. We also refer to this as the net realizable value. Net realizable value. And that basically means this is the value that we think our asset is ultimately going to realize or really happen, okay? We don't think this is really going to happen because we know there's a chance that a lot of our credit sales won't be collectible. This is a more realistic or realizable value, okay? Net, again, referring to net of the estimated uncollectibles, realizable, referring to more realistic value, okay? And now let's look at our income statement and the impact this has. Well, what the impact this has here is that we have our $100,000 of sales, credit sales from 2013, and we're also recording our bad debt expense related to those sales, right? We generated $100,000 of sales by taking a risk, by letting our customers give us time to pay, not pay us in cash right away. Well, the risk associated with that is our bad debt expense of $2,500. Now, again, it's an estimate, but at least it's something, okay? It's better than showing something overly optimistic or showing no risk at all. And as you see, we're matching the revenue with the related expenses all in the same period, all in 2013, because this is our 2013 income statement. So our income statement follows the matching principle. Okay. The next entry we're going to learn about is writing off. So once we actually do decide that some of this is uncollectible, we're going to give up on it, what does that entry look like? So our problem says during 2014, okay, now we're in the next year, Jennison Inc. decides to write off $3,000 of accounts receivable. So what that entry looks like is a little bit different than the one we saw before. Now again, we still want, once we give up, we do want to take it out of our actual accounts receivable. So you see here, we're crediting accounts receivable. We credit accounts receivable here for the write-off. But the other side of the entry is not bad debt expense, right? We already recorded that bad debt expense in 2013. Instead, we're going to record it to allowance for doubtful accounts as a debit. So what does that mean? Now remember, allowance for doubtful accounts is an estimate. Okay, we're not sure yet if we're going to give up or not. We just think it might not be collectible. So by crediting the allowance for doubtful accounts when you do a write-off, it's essentially removing it as an estimate, saying it's not an estimate anymore, rather it's a known uncollectible. Okay, it's not an estimate, so we take it out of the estimate, and instead we say that it's known uncollectible. Okay, so what the write-off under the allowance method does is, number one, it removes the accounts receivable from the asset, right? We see it coming out of the asset right here. The second thing it does is it removes the estimate. Okay, we're taking it out of the estimate, right? The estimate was on the credit side, so our write-off is on the debit side. Removes the estimate. Now it's a known uncollectible. Went from being an estimated uncollectible to a known uncollectible. And the third thing the write-off does is it does not impact expense. Okay, if you look here in this entry does not touch expense at all. And the reason why is because we already matched the expense with the related revenue in 2013. So we don't want to touch the expense again. We already did that back in 2013. Okay. So, remember, with the allowance method, we say that at the end of every accounting period, we have to estimate bad debt. So that means that at the end of every accounting period, we have to adjust the allowance based on what things look like at the end of the next accounting period. So this is another adjusting entry that we're going to have to record at the end of every accounting period. So this is how that works. In our example, it says, during 2014, Jennison Inc. had $120,000 of credit sales. During the year, Jennison Inc. collected $105,000. Of the remaining balance, Jennison Inc. estimates $4,000 may not be collectible. Okay, so here's our beginning balance that was left over from 2013. Here's the write-off of what we decided we're really going to give up on. These are the additional sales in 2014, and these are the collections in 2014, leaving us with a balance of $37,000. Okay, so what you want to do, similar to other adjusting entries that we've done, is the three-step process for adjusting entries. Number one, determine what the unadjusted balance is. So that means we go to our allowance for doubtful accounts, and we see, okay, this was our beginning balance, this was our write-off, this is currently what's in our allowance for doubtful accounts, okay, a debit of $500. The second thing we need to do is to determine what the balance should be. Well, our problem here tells us that of this remaining balance, $4,000 may not be collectible. So that means that our balance in allowance for doubtful accounts should be $4,000. So now we have to record our adjusting entry to get from step 1 to step 2. Now this is a little bit tricky because you see we have a debit balance on one side and we want it to be a credit balance. So what that means is first we have to negate this debit balance. So you negate the debit of $500 with a credit of $500 plus the ultimate credit of $4,000. So you're going to take the $500 plus the $4,000. You're going to have to credit both of those, and that's going to get you a credit of $4,500. Okay, so this is going to be your entry. A credit of $4,500 is what you need to get from a debit of $500 to a credit of $4,000. So you got your debit here of $4,500 and your credit here of $4,500 for bad debt expense and allowance for doubtful accounts. In the next video, I will show you the financial statement impact of this adjustment.